The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, thank you for joining the UKOUG EPM and Hyperion webinar. It will begin in 3 minutes time. Just bear with us for now. Thank you.
Hi, it's 12 o'clock. I'd like to welcome you to the UKOUG EPM and Hyperion webinar with Huseyin Alakca from the Hackett group. My name is John Baker from the UKOUG committee, EPM and Hyperion committee. We'll be starting the presentation shortly, but before we do that, there's just a couple of housekeeping things that we'd like to go through. If you've got any questions, then please put them into the question box. We will try and read those out during the session. I'll be asking Huseyin questions that are appropriate, and if we have time at the end, we'll be able to pick up ones then as well. If you can't hear us, then please put that into the chat box and we will try and resolve the issue. After the event, we are going to send an email out, and we'd be grateful if you can complete that survey, as well as giving suggestions for future events. This is the first in a series of webinars that we hope to run on a monthly basis. So on the 21st of March, there will be an update from Oracle Product Management in the same format as this. And we've also scheduled an event for the 25th of April. The topic is currently to be confirmed, so if you have any ideas for that or future agenda items, then please let us know on those as well. Also, there is the annual UKOUG EPM and Hyperion event in the 14th of June in Sandown Park. The call for papers for that will be opening shortly, so please look out for that and submit items for that event. Too far. So I'd like to introduce Huseyin Alakca from the Hackett group to talk to us about why budgeting is not accounting.
Thank you, John. I need to, I think, take now control. Yeah, so hi everyone. I'm going to go on slide presentation mode. So you can see just a second. Slight technical issue here. Can you see the presentation?
Not at the moment, not in presentation mode, Zane. It's still in. Do you want to just press F5? Yeah, there you go.
Okay, cool. Okay, guys. So we have, I think, 55 minutes left. We have a hard close at 1 o'clock because I have a flight to catch from London City. So as John outlined, my name is Huseyin Alakca. I'm based in London with Hackett now for nearly 8 years. I'm a planning, budgeting, forecasting expert. I have redesigned, assessed, and implemented changes in redesign across the various industries, various clients in Western Europe, Northern Europe, Southern Europe, Asia, Middle East, and North America. Today we'll be talking, as John outlined, why budgeting is not accounting. It's a short deck. I don't want you to overwhelm you with many decks. I would say that I'm sure you see many decks and many slides, I would say. I think it is important, as John outlined, for you guys to ask at any time questions. Yes, you guys are on mute, etc., but that doesn't mean that we should also not make it as interactive as we can make it. Before I go into the core of the deck, I wanted to show you a couple of slides, I would say, on best-in-class performance. Now, if you look at, some of the challenge that we see in the market, you look at, I mean, there's various studies that have been done, and this is one of them on the left. The leading companies, whether they're in any industry, whether this is pharmaceuticals, whether this is retail, etc., are dropping from their top 5 or top 10 positions after a couple of years. And it is very difficult to lead, so to stay in the top 3 or top 10 even. And there are various reasons for it. Of course, there is this external challenge that you have, the uncertainties, the change in the market, the digital disruption that you have, etc. But you have also internal challenges very often. I mean, if you look at some of these challenges that they have outlined here, this is not exhaustive, of course, but this is quite typical. Whenever I go to talk to a client, these are typical things that we see usually, that the budget has no link to a strategy. For instance, strategy is, of course, high-level vision, and budget tends to be substantially more detailed. Very often they're not linked, or the targets that are in the budget has not been derived from the strategy, or it's not clear if I achieve the budgeting targets, how that relates to the strategy. There's a lot of detail, and especially outdated detail. You have lots of past clients who have thousands and thousands of line items, where basically actual equals budget sometimes, and sometimes even forecast. So forecast equals actuals equals budget, basically line items, which is quite a cumbersome thing. The other thing that we have, of course, especially companies who have not implemented Hyperion planning or other tools, etc., that these planning processes, when it comes to budgeting, for instance, can be very time-consuming, but very manual too. Excel files are spreading all over the world. Templates are basically sent all over the world and then collated, consolidated, reconciled, aggregated, changed, and then sent to group FP&A. Forecasting accuracy is something that we see as a critical point too, which is low in the majority of organizations, especially in organizations that are highly volatile. I would say where basically the industry is going through tremendous change. Semiconductor is one of them, energy is another one of them, retail is another one of them, where the forecasting accuracy can be quite, I would say, low, because the environment is constantly changing. I think another point that I wanted to raise, and I will go back to some of the good practice, is the ambiguity around ownership. Very often people talk about budget, they talk about strategy, they talk about forecasting, but it is not really clear who owns what. And also the vocabulary can be different from one department to the other, one country to the other, or one division to the other. So these are things that we really see as I would say, an internal and also an external environment challenge that are affecting the FP&A function. If we drill down a bit more, we have done, of course, I'm sure you all know, Hackett is well known for performance studies, benchmarking, and all kind of, I would say, assessments. We have something what we call world-class. World-class in finance, basically, is the top quartile in efficiency and effectiveness. And if you look at world-class companies that are world-class in FP&A, especially in planning, you see that there is a correlation of good planning versus better shareholder value, better forecasting accuracy, and overall total shareholder return is just higher, I would say. On the right-hand side in the middle of the graph, you see an example of how slow and fast companies spend their time. You see that if you take a typical budget, basically, that is long, time-consuming, etc., 150 days, some companies spend more than 150 days basically on their budget. And if you look how much of that time is spent on forward-looking activities versus data collection, etc., it doesn't come as a surprise, of course, that these companies who spend a lot of time doing planning don't have time to do more forward-looking thinking. So it's a lot of the data validation and data reconciliation. Give an example. I'm currently working with one of the biggest banks in the world, and that bank basically spends 7 months of its time to basically aggregate data, validate data, reconcile data, change data. But it's all data sort of discussion points, but less about forward-looking thinking. So what does that mean for us? Where can we add value, really? On the right-hand side of the chart, you see what we call the FP&A processes. This is Hackett definitions. And what we did basically, we said, okay, let's split where the FTEs are doing their activities. And if you look at it, if you split them by various process categories, strategic planning, budgeting, forecasting, etc., you see that and this is world-class split, leading companies are spending nearly half of their time with business analysis. And quite, I would say, a bit of time also with reporting, but less so. And of course, the remainder of the time is mainly spent on strategic planning, budgeting, and forecasting. It doesn't come as a surprise. If you take this cake and apply it to an average company, I would say, they would spend substantially more time with reporting, substantially more time with budgeting. Leading companies tend to have, because they have automated better processes and adopted some of the leading practices, they can afford to spend less time on transactional activities, but more time on forward-looking activities. All good, I guess. With that, I would say, let me move to the next one. I don't want to spend too much time here, but I think it is important to understand what is what. When we talk about the budget, which is the focus of this exercise we're talking about, we're really talking about the plan for next year. It is mainly, of course, financials, but not just financial. It has also the business actions that are attached to the financials to achieve those targets that have been set by the management. Horizon typically 1 year, no surprise. Whereas strategic planning, of course, is much more long-term, much more non-financial, probably 5 to 10 KPIs. These can be financial, non-financial, and much more visionary, I would say. Whereas the financial focus, of course, is really just a health check, basically, an early warning system, done on a regular basis, quarterly, monthly, depending on the industry in which you are, and could be until year-end, could be beyond year-end. I will focus in this presentation around... Yeah.
And do you find a lot of organizations using some of these terms almost interchangeably, and that becomes a cause of confusion?
Yes, absolutely. It's a good question. Thank you for that. This is a critical, what I will call a critical disease that we see in the market, basically, that basically forecasting is being considered as an extension of the budget, more or less, rolled forward, and budget is nothing more than a detailed strategic plan. That's something that we typically see, but it is absolutely critical to I would say, distinguish them. And there are a couple of reasons. Strategic plan is typically owned by the group CEO. It is done in conjunction with the group controlling group FP&A, whereas budget is typically owned by the CFO, not by the CEO, and has the targets and the actions behind that. And the financial forecast is nothing more than a high-level health check where we stand. So it is absolutely, if you look at the level of details of all of them, they're different, as I'm sure you have realized that now, and the owners and the input providers are different. For instance, the financial forecast has a substantially bigger input from the business, from sales and operations, etc., because they need to provide their views on how the market is going to go. Whereas budget tends to be substantially more finance-driven. Strategic plan, on the other side, is substantially more CEO-driven. with the respective divisional hats or business unit hats, however you want to call that. So it's something that we see in the market. That's the reason why, for instance, with some of our clients, we develop what is called a playbook, where we say, okay, what are the critical guidelines, the critical things that we need to understand so that everybody speaks the same language. And we did with one of the biggest retailers in this country, in the UK, we develop a playbook where we basically defined these components and made sure that the ratio, the responsibilities, the input and output of the various parts are clearly defined. Other questions, John?
No, that's great. Thanks, Huseyin. Sorry, struggling to find the unmute button.
That's okay, no problem. So let's continue to the next one. So what I did basically, I am going to talk about 4 main, I would say, good practices in budgeting. This is not an exhaustive list, but it is at least should give you a first, I would say, initial flavor of what good practices are. Of course, we always start with the target setting process. Target setting process tends to be quite a cumbersome process because A, very often targets are soft, are not hard. B, it is not clear how targets are derived from. Targets sometimes might change throughout the year. So these are the sort of, I would say, challenges that we see. In a good practice company, basically, you would have front-loaded targets that are hard, non-negotiable, non-discussable, discussed basically, and then the organization at the lower part will just, I would say, work on how to achieve these targets through business actions. The targets themselves cannot, of course, come from the blue sky. They usually come from 3 sources. One is the strategic plan. The other is basically the competitor benchmarks, how your competitors doing, etc. And if you're quoted on a stock exchange, any analyst expectations that you have. All 3 should be taken into account. There's a 4th element that usually companies take into account is that when they set the targets for next year, they also look at the latest available results of the rolling forecast and use that as an input to basically stress test the targets to make sure that was still feasible. So this is what I would say a good practice that we see. I want to re-emphasize again that changing the targets throughout the year is not a good practice. It is something that causes a lot of pain within a lot of organizations, I would say. If organizations are absolutely going through tremendous difficult change, etc., if processes are automated, changing these targets throughout the year would be easier then. Because when you change targets, typically organizations have to recut the budget, come with different budget versions, etc. So it's quite a painful process. But if your processes are manual, it's going to be even more painful. But it is not good practice, again, to change targets throughout the year. So that's front-loaded target setting. Then we have planning in 2 steps. In order to, I would say, avoid overwhelming the organization and involving all possible countries, legal entities, business units, divisions, etc. in a detailed planning cycle, some of our clients, and this is mainly in the consumer goods industry, have a 2-step plan basically, where they say, okay, step 1, we plan up to, let's say, region/division level, set the targets, make sure that everybody's clear where we stand, etc., have a high-level view about the financial and non-financial numbers, and then stop there basically, because for our board presentations, we don't need to go at legal entity level. The board doesn't need to understand whether the legal entity Paraguay has a target of 5 or 10. That's completely irrelevant in the wider scheme of things. That's step 1. And step 2 then, through automated allocation processes, they will then cascade these high-level, I would say, budgets to legal entity level processes through to cost centers and entity level, etc. But the step 2 is a mechanical step. It is not a step that involves a lot of brain power, to be honest with you. And there are many tools that can do that currently in the market. So various tools can do that. And the step 2 is not, I would say, has not binding targets. It's just something that makes sure that, for instance, auditors are happy when it comes to things like impairment tests, etc. But also sometimes, for instance, in the insurance industry, that's the case. you need to have some capital planning and some legal entity level balance sheets and P&L statements, even if they're not absolutely precise, in order to satisfy the regulatory needs. So things like that are also can also be, I would say, covered by that. But they're not ultimately relevant. But what this does, though, is that it basically has the view of, okay, I give you targets, and you go about and achieve those targets. Whether you have all this nitty-gritty detail, etc., I don't really care. It is a mindset of, I would say, to some extent, trust, and moving a bit away from this control mechanism that when we go to a board presentation, you have to have hundreds and hundreds of pages of numbers and numbers and numbers and numbers that down the road in a couple of months nobody is going to use. So that's step two, basically, of one of the good practices that we see in the market. The other one is, and everybody talks about that, but nobody does it really properly, is driver-based planning. Driver-based planning is not a value driver. It's basically saying, okay, if I would change a business driver, let's say we're in the retail industry, you change availability in the store level, or you increase the payroll in the store level, how would that affect, for instance, the sales numbers? So it is the linkage between the business drivers that you change and the financial outcomes that you're going to have. Typically, you might have a driver model for sales, you might have a driver model for cash, and one driver model for profitability. That's typically what you typically see in the market. It is recommended not to inflate the number of drivers, because you might have hundreds and hundreds and hundreds of drivers, but not all drivers are equal. No, they're not. Some drivers are more important than others. And for instance, we are currently working with another client where we do correlation and regression analysis, where we're helping them to understand, okay, we are hearing, they basically told us, we're hearing from the business that, I don't know, GDP growth is an important driver. But we realized that by doing correlation analysis, etc., regression analysis, that this was not really the case, that it was not really the most important driver. That brings me to the second point, which is you have to weight the drivers, meaning some drivers, of course, will be more important, others will be less important. So we need to weight them, saying, is the weighting 50%, 100%, is A more important than B? That's the first thing that you need to do. The second thing that we need to do is lag time. Not each driver are impacting financial outcomes immediately. For instance, inflation might increase, but the retailers might decide not to pass by the inflation immediately to customers, but do it after 6-7 months. The same thing is, for instance, when you're in the mining industry, if GDP growth of China, for instance, is, let's say, better than expected, and China is a massive consumer of mining industry products, then the impact, you don't see it immediately. You see it probably after a couple of months' time, or even sometimes a couple of quarters. We have the same thing in the construction industry, for instance, where the permits, the planning permissions basically, do not immediately affect the construction industry's upturn. But if the planning number of planning permissions granted increases, basically, typically we would see the effect after 5 and 7 months. So what I mean by that is basically the driver-based model is very industry-specific. It is really critical to the company which we're talking to, whereas front-order targets and planning in 2 steps can be industry agnostic. The final point is around less complexity. And yes, I have a couple of numbers around that. Less complexity means you basically budget very limited line items. And this is a big challenge. This is especially a big challenge of an organization that have an accounting mindset, because they basically believe budget is nothing more than forward accounting. But that's not really the case. What is budget ultimately? Budget ultimately is nothing more than I would say, a commitment to targets that you set yourself for next year. It is having all the nitty-gritty detail might be reassuring, because humanity and human beings like detail, but it is not, and historically we have proven that, going to help you to achieve your targets. You might have 1,000 line items, but that doesn't mean that it's better than 5 line items. And if you look at leading practices, sorry, I'm going to go back to that slide a bit later. This is a couple of, I would say, areas where we show. If you look at that basically of P&L line items and balance sheet line items, etc., we split them into non-core and core. Central means you submit them to the group FP&A team, and non-central means they're specific to the divisional, because divisions might have specific line items they might need to add. So typically you would see basically a median of 30 for P&L, and median for balance sheet is basically 20. We have clients who have substantially less than that. We have clients who do budget just 10 line items. In the past, we had clients, we worked, John and myself too, worked with a telco company. They basically had 10,000 line items. Now, 10,000 items is quite massive, I would say. And to be honest with you, it moved away from becoming a sensible exercise into an intellectual exercise where people were lost in the detail but didn't add any value ultimately, because after 6 and 7 months, this budget was outdated. It had too many line items and people were lost. And also, you can't give people too many targets too. So you have to give people limited number of targets. But organizations that move to less line items, less detail, tend to be organizations where the management does trust its employees to deliver the numbers and empowers them to deliver these numbers. So there is I would say, a management training here to be done too, hand-holding too, because very often people at the middle management level feel threatened or feel not confident not to go with all possible answers to the management. But this is the way forward. I mean, let me give you an example of one of our leading companies that we work, Bosch, for instance, an automotive supplier. We basically worked with them on a planning area, and they reduced the cycle time of their budget from 6 months to 8 weeks, which is radical. For a company that has 60 billion, is present in 180 countries, that's quite radical. And they also radically reduced the line items that they would plan. But what they did also, that they basically trained the management in changing their mindset so that the management couldn't ask any more detail. It was simply not available. So there is a hand-holding training thing to be done too in order for the management to get there. And historically, management that is too detail-focused, of course, will struggle a bit at the beginning, but there is a journey there. I mean, one way to do that, for instance, is to make sure that they can talk to peer companies, and we can arrange that to make sure that it doesn't come just from consultants, basically, but comes from real clients who have reduced their line items. I mean, Henkel's and Bosch of this world, etc. And then they get reassured, I would say, by looking at that. Maybe with that, let me go back. I mean, I quickly walk through some of the critical things that good planning needs to have. Questions on this side?
So, Huseyin, you talked a bit about the driver-based planning in there. Is there much value in a simple sort of sales volume driver basis?
Yes, there is, because ultimately, so there are two ways. One is, in the long run, you want to make sure that driver-based planning replaces or is the main mechanics tool you do planning. So that line items down the road are being generated automatically through driver-based planning. That's a long-term vision. When it comes to the sales numbers or sales question that you had, is that our clients typically use the sales driver tree as an initial point to basically stress test the annual targets around sales numbers. Sales typically is a target across nearly all industries. You might not call it sales, you might call it revenue, net gross written premium, net income, whatever you want to call it, but sales is a target. And because it's a target, it is an important element to start with. It is difficult to start with, I would say, just operating profit or cash. And it's also difficult to do all components at the same time, meaning revenue, sales, operating profit, and cash. But we have clients who do all three of them together, because they're saying just by showing me that this sales number is right or wrong is not enough, because ultimately I can increase my sales numbers, but if I don't know what the impact is on my bottom line, I might be made loss-making, but the paper might show me, oh, this is great. So there is a trade-off that needs to be done, but it depends a bit on the maturity of the organization, unfortunately. If you're a bit mature, you can do three at the same time. You can do basically revenue, operating profit, and cash at the same time. And they also link to each other, of course. I give you an example. You might well say, going back to the retail example, you might well say, okay, let's increase availability in all stores all over the world to 98%. That probably is a great thing. That will increase our revenues, etc., but it will massively affect wastage, for instance. Things that you basically will have products on the shelf that you can't sell because, and that's going to, of course, have substantial cost implications to it. It has distribution cost implications, of course. The more stores are available, the more distribution drops you need to have, etc. So there are trade-offs that you can only see when you combine sales model with operating profit and cash model. In an ideal world, I would like us to do 3, but clients usually start with sales.
Okay, thank you. But also you were talking about reducing the amount of detail available to people and basically stopping management from having access to it. Does that sort of change management and cultural issue, is that the hardest part of this process?
Absolutely, absolutely. Any planning redesign is not about even driver-based planning or planning in 2 steps or target set, etc. All that is, I would say, good mechanics and should be done, etc. Planning redesign is not process redesign. It is a mindset shift and mindset change and philosophy change. Hence, it requires some timing. And that's the reason why I always recommend my clients, if you are to engage consultants, you need to have very senior people to do these projects, not some junior data monkey people, etc. This is really senior type of work that you need. Hence, there's a lot of hand-holding and convincing to be done.
Thank you.
Okay. Other questions on the stage?
Please feel free to type questions into chat if they're there, but there are no further questions at the moment.
Okay, so what you see currently, I want to show you some example of, I would say, benchmarking exercise. As you guys know, we have, of course, a lot of data, etc. And this is a company that we have benchmarked. I call them ABC company. Doesn't have to be. I mean, it's just one client, I would say, of ours, of course, anonymized. You look at, if you start with the top left and then work downward, you look at, for instance, things like, is the strategic plan fully integrated with the budgeting process, etc.? How long is the cycle time, world-class versus them? How much time do they spend on data collection versus analysis, etc.? How is the FTE split? Now, all these KPIs are important, but there are 2 that basically drive a lot of things, I would say. One is your cycle time, which is in the middle, which is driven by the amount of best practices that you've implemented. Front-loaded hard targets do reduce the cycle time and make the cycle time of the budget shorter. A shorter budget tends to have also a higher budget realization, meaning what you promise to do and what you actually deliver is, the difference is lower, meaning you basically meet your annual targets much better, which doesn't come as a surprise, because the longer a cycle time is, the more outdated the budget becomes, and the more difficult it becomes to some extent also to meet these targets, because the focus is being moved away. The other thing that we see here is automation. It doesn't maybe come across well, but it's quite a critical thing. And yes, Hyperion planning and various other tools are helping in that, but let me be very clear, tool in itself is not, I would say, the savior. The processes in the adoption of best practice need to change, and these changes need to be reflected then into a tool. But the other thing that we need to have is that if you were to go to world-class budgeting processes, you would also need to have, I would say, world-class capabilities in budgeting. That means, for instance, the business acumen within the FP&A teams need to increase substantially further. They need to be able, for instance, to challenge the business on the numbers that they provide. That requires, of course, I would say, strong business acumen and modeling capabilities, etc. So drive it, for instance, with one of the clients, it's an insurance company, we're working with them in Germany. We basically are developing with them a driver-based model for the FP&A function to basically challenge the business to come up when they submit their numbers. And of course, the driver-based model will help FP&A team members to basically challenge that. But without the business knowledge, without an understanding how this business works, etc., it doesn't really help them. So they need to combine the mechanics, I would say, with the business acumen, and enabled, of course, by the technology landscape. In this case, they use an SAP tool, because in Germany, more widely spread, to basically, I would say, model it and challenge the business. I was talking about integrated planning, etc. at the beginning. I mean, this is a client example. So whenever we talk about, and we talk about at the beginning, we said the budgeting should be integrated, etc. As here on the top left, as you can see. If you go back, to integrated planning. What I mean by that is that your every calendar starts always and should start always with a strategic planning process. That tends to be and should be a long process. 5 to 6 months is not unusual. The cycle time of the strategic planning process is irrelevant. The longer it takes, the better it is, to be honest with you, because it's a small process with very few people involved, etc. It can take a long time. So your ambition should not be to make the strategic planning process short. That will be, I would say, skewed ambition. But your ambition should be what comes afterwards, the target setting and the budgeting process, is really condensed, etc. So this is a consumer goods company here. And in consumer goods industry, of course, especially if you live in the Western world, Christmas becomes, of course, a critical period. Hence, we basically made sure that when we have the strategy conference, which is in September, basically, you basically make sure that the long-term strategic targets are set there, and then you cascade it down using the target letters, and then you start with your usual, I would say, budgeting process. Going back to best practices, if these target processes, which is in the October section, if these targets are not, let's say, hard, front-loaded, etc., you would always have to go back from the end and go back again to these targets and have these never-ending reiterations and alignment discussions, which we don't want to have, to be honest, because they're not particularly of use. In this case, because there was a Christmas break where basically business couldn't do anything, etc., we said, okay, we're going to revisit some of the target components after Christmas, because Christmas trading does affect the target setting process. But this is quite, I would say, a very industry-specific nuance. If you go to banking, if you go to pharmaceutical sector, if you go to, let's say, car manufacturers, etc., whether Christmas or not Christmas doesn't matter. And the other thing, of course, is that if you go to other industries, other regions, in China, for instance, Chinese New Year will be important, etc. So these are nuances that we have to adapt, I would say. But it goes back to one thing. If you look at this budgeting process, it's relatively short, and it's not yet as short as it could be, but that is because this is the first level of ambition that they had. The second thing is that the target setting process is directly attached to the strategic planning process, and there is a reason for that. If you have this strategic conference and you have, let's say, a couple of months of break, let's say you had October and November as break, and then you start with your budgeting process, that will be too late. There is a reason for that. You have assumptions in your strategic planning process. You need to make sure that those assumptions, FX rates, GDP growth, inflation, etc., market environment, that all this is affected or used in your budgeting process too. So it's important to make sure that whatever you have in your strategic conference in terms of assumptions are also used in the budgeting process when you start the budgeting process. Bayer, for instance, which is a pharmaceutical crop science company based in Germany, they have in the middle between the finalization of the strategy and the beginning of the budgeting process a management board meeting where they revisit the assumptions from the strategic plan process and say, are these assumptions still relevant or valid? And if they are valid, then they start the planning process with those assumptions confirmed. Questions?
So you talked about this being an interim step, or the first part of a journey for somebody, and that potentially that budget cycle is going to compress further. Over what sort of period do you think somebody would go from very bad practice towards world class?
I mean, there are two answers to it. One is your capacity for change, of course. Let me give you two examples. E.ON, for instance, E.ON is a utility company. We've worked with them in the budgeting and forecasting redesign process. Because it was historically a very big organization, complex organization, not always conducive to change, it took them 2 years basically, or maybe a bit more, 2.5 years, to move from 7-month cycle time to roughly 3 months. Okay? There are other organizations like Bosch, for instance, where they move from 6 months to 8 weeks within 12 months' time. So it all, I would say, a question of ability to absorb change and not, etc. Historically, organizations that have managed change professionally have and do not have a federated structure tend to be quicker in, I would say, moving to really short cycle times. Organizations that have historically been more federated, where everybody has their own kingdom, etc., that's where it takes longer time. And there's also a cultural element here. American and French-centric companies tend to be much more top-down. I would say UK, Netherlands, Northern Europe, continental Europe, with the exception of France, tend to be more consensus-driven, hence where it takes a bit more longer time to, I would say, get to these shorter cycle times.
So presumably that executive sponsorship becomes key during the cycles.
Absolutely, because I mean, if the CFO and CEO are not behind that, you shouldn't even start this journey. Just stop it immediately, because it's going to be fail. And the other thing is that this is not, let me repeat again, this is not a finance journey. I know that people think, yeah, budget equals finance, etc., which it is to some extent, but business involvement is really critical here. At Bosch, for instance, the leader, the main leader of the project was somebody from business, a representative from the business. It is important because ultimately, although finance does coordinate a lot of these activities, if you look at things like business planning, etc., which happens in this case between October and November, this is business activities. So business have to be involved in that, and also it affects their money, it affects their bonuses, it affects their remuneration, etc. So it's quite an emotional topic. So business have to be involved in detail in that discussion.
So that link to compensation is key as well?
Absolutely, because for instance, of course, the shorter your I would say, your line items are, the fewer line items you have, usually the fewer, I would say, targets you're going to have, but these targets can then be ambitious. Because as I said at the beginning, these targets need to be derived from strategic plan, external benchmarks, peer comparisons, and latest available forecasts. They will be more robust but ambitious. That's one thing. I think the second thing is also is that what type of behaviors do you want the organization to drive? For instance, you might say, okay, I want forecasting accuracy to be part of my compensation scheme because I believe that forecasting is not accurate. If you want to drive such a behavior, it will have also disadvantages, of course, there's no question about that. Then you might, well, I would say, make sure this is reflected in the compensation scheme. But you should not, I would say, just redesign the process without affecting the compensation scheme. That's something that has to be done. For instance, one of the things that we've seen some clients do, rarely though, is that they would even put the cycle time reduction as part of I would say, compensation scheme or target setting scheme of the head of FP&A, for instance. They would say, okay, we want you to reduce the cycle time from, let's say, 5 months to 4 months, and this is part of your annual target.
Okay. Thank you.
Okay. Any other questions?
Not at the moment. If I can remind people, if you enter into the chat and send questions to the organisers and panelists or everybody, then we will pick those up and I'll pass them on to the same.
Okay, so a couple of things maybe. I mean, this is an example from another client that we did basically, and as you can see, it has the two-step planning best practice basically that we discussed initially. So one is that no intercompany should be done. There is no intercompany budget, etc., guys. This is not good practice. Nobody cares about that. You have 5 budget line items or 10, that's it. This is not an accounting exercise. You budget only the critical items. And there's a saying in American, I mean, 20 is plenty basically. I would say that. 20 is plenty. Remember that. It's really plenty. Yes, it is not accounting because it does not have to comply with some accounting standards. You don't have to, I would say, sign off your budget by the auditors, etc. That's not what it is. Of course, there are things like impairment tests and various other things, but that doesn't require, I would say, an accounting view of the budget, etc. There are, though, I understand that, specific components that you need for regulatory bodies if you're in the banking industry, which I understand. The other thing is that, of course, this balancing thing. Well, it doesn't have to be balanced because we're not creating any balance sheets, any P&L statements, any cash flow statements, but we're taking components of it, the critical items only. Anything else, and I'm willing to be challenged here, is really noise, unnecessary noise.
I think there could be a big cultural issue to that side of trying to move accountants away from thinking of things as accounting and balancing. Is that one of the harder changes that you see?
I wouldn't say so. I think people get it quite. I mean, typically FP&A functions tend to be more business centric, I would say, than the accounting function per se. It's less, I would say, hard as long as you explain them what is good practice and how others have achieved that. They quickly, I would say, get that this is not accounting really. And also, if you look at the exercises that the FP&A function go when they go through the budgeting target setting process, it's not really accounting. I mean, you don't talk there about is IFRS 9, IFRS 15, etc. How should we do it? You see what I mean? So the discussions are substantially more business target-centric discussions. Hence, it's easier to convince them.
Okay, thank you.
I mean, we discussed a bit about that already. I at least discussed about that. And this is my final slide, which is really planning succeeds and fails with behavior. It's absolutely critical. The change management aspect is absolutely critical, I would say. And there are a couple of things. Yes, targets, of course, are binding. No question about that. As I said, they are hard and front-loaded. But this is not quantum physics. We're not here to write, I would say, a PhD thesis about gravitational fields. That's not what it is. It's really about how do we make sure that the business actions we have will help us to achieve those targets. We have to accept that actual is not plan, which is a critical thing. And you can have comparability. You can say, okay, I want to compare whatever my actuals at the very top level and with some of my budgets, etc. But we should not expect that actuals and all the counts and child accounts, etc. is the same as plan. You can go that path. You can automate complexity if you wanted to. It is not good practice. And I don't think it serves any purpose. I think that budget is not forward accounting. We discuss in detail about that. The other thing I want to make sure is that we have to accept that budget and focus are wrong. They will be wrong. It's just how wrong are they going to be? And yes, there is a lot of uncertainty, but you will not get certainty by having, I would say, thousands and thousands of line items that will not give you a better forecasting accuracy or a better budget. Contrary to that, we have done studies where we basically look at the cycle time of a forecast and the forecasting accuracy. And our studies have shown, and I have hundreds of examples of that, BMW for instance, an example too, where the longer the cycle time of a forecast, the less accurate it becomes. Which would be a bit more counterintuitive. You might say, yeah, but if I have more detailed data, that means I'm more robust. Well, it's not.
Less is more.
Yes. So this was, I think, my final slide, apart from my beautiful photos, etc. Questions, suggestions, disagreements? I mean, I admit that this is quite a high-level flavor. It doesn't go into too much detail, etc. But I would say the timing doesn't allow that.
No, clearly not. But please, if you have any questions, type them into the chat box now. Otherwise, I will remind you about upcoming events, and we will move on.
Yeah, maybe one thing though, if you have any question that you have that is beyond that said, please drop me an email, no problem, or ask John or any of the other guys like Anna, etc. And I'm very happy to answer your question.
Thank you very much, Huseyin. Could you pass the presentation view back to me?
Okay.
So thank you for that, Huseyin. hopefully thought-provoking for you. As I said, this is the first in a series of webinars that we are launching on a monthly basis. So on the 21st of March, please make a note in your diary that we'll have an update from Oracle Product Management. A further one coming on the 25th of April, and agenda items welcome for that, as they are, and call for papers for the full UKOUG Hyperion event coming up there. We will be sending out a feedback survey for this. As I said, this is the first in a series of events. We want to make them relevant to you and seek opinions as to how we can make them better, get new items going forwards, and look at it going there. So please take the time to fill that out. I do have another final question come in while I've been doing that says, what do you suggest if tax teams need budgeted statutory profit by country for tax planning? This would need
good question. So the way we go about that is basically BASF does it this way. We can create a theoretical balance sheet and P&L statement at the corporate center by the central FP&A team to meet these requirements. BASF does it exactly that way, but that doesn't have to involve the entire organization. That can be done at the top level.
Okay, thank you. Might there be challenges when it comes to explaining variances to actuals if there's little detail in the budget?
I think the point is that instead of, I would say, trying to explain the variances, it would be much better to explain the underlying business driver. And I think we have to, FP&A functions have to move away from just explaining what is the difference between, let's say, actual 10 and budgeted 5 versus what is the underlying business driver and how can we, I would say, influence that.
Okay, thank you very much. The final one is also, will the slides be available? I know the session's being recorded so that people can review it and see it again. Are the slides going to be available to the attendees?
I haven't thought about that, to be honest with you. John, we will need to take this offline.
Okay, fine. Thank you for that. Okay, it is 12:50 at the moment. Thank you, everybody from the committee, Hyperion EPM committee. It's great to see so many of you on this, and we look forward to seeing you on the next ones.